G'day folks, it's Jim here from AudUsd Forex. It's Saturday the 24th of July and the markets have just finished on a quiet but pretty positive note. The FX pairs generally were pretty steady. The euro is hanging in there above important support at 117.70, trading a pretty tight range all week, even around the ECB meeting. But it's hanging in there, doing not an awful lot, but probably looking a little bit heavy. Elsewhere, the other currency pairs were also fairly steady. The US dollar retained a quietly bid tone, I guess, and noticeably the Aussie and the Kiwi both made multi-month lows early in the week, but bounced progressively as the week wore on, in line with the improving risk sentiment. The real action once again on Friday was in the stock markets, which saw the Nasdaq and the S&P make new all-time highs again, and the Dow closed the week above 35,000 for the first time. Even the ASX futures market in the States, despite lockdowns currently going on in Sydney, Melbourne and Adelaide, that broke to new all-time highs and finished above 7,400 for the ASX 200. So we look for a pretty positive start on Monday. Strong earnings helped the US indices on Friday, led by decent results from Twitter. And noticeably next week we've got results coming out from Microsoft, Google, Amazon, Apple, Facebook, and also from Tesla. So it's going to be a pretty big week for the markets, with not an awful lot else on the calendar, apart from, of course, on Wednesday the FOMC meeting takes place, so all eyes really will be on that. In the commodities sector, oil, having had a decent sell-off on Monday, that bounced quite dramatically really throughout the week and finished with most of the damage, or much of the damage, having been reclaimed. And the other interesting market really at the moment is gold, which is hanging in there above important support just below 1800, 1790, 1800 looks to be pretty important, and if we go through that, gold could go a lot lower, but we'll go and have a look at the charts in a minute. As far as the FOMC meeting, I don't think we should be expecting any really great surprise from Powell. The Fed have said that they will give notice of any major policy update well in advance, so I don't think we should expect any surprise announcement with regards to tapering of bond purchases. And inflation, although it has spiked higher recently, forward expectations seem to be slightly more measured. Given all that, I think conditions remain probably mostly unchanged. The labour market's dithering a little bit. So with conditions pretty much unchanged from the last meeting, I suspect this current FOMC will contain no real great surprise. Anyway, with that, we'll stop there and we'll go and have a look at the markets.
Okay, folks, so we'll start off with the dollar index, which, as you can see, finished at 92.90, and that equates to really just having broken the neckline on the upside, allowing for potential for further dollar strength in the weeks ahead. The weekly indicators, the MACDs, they still look slightly positive. But having said that, the dollar does need to get on with it. We've had 4 or 5 weeks of slowly moving higher towards the neckline. This equates to 117.70 in the euro, and that seems to be hanging in there. We'll go and have a look at that in a second. So if we are going to make further progress, we really need to see another positive week, I think, for the dollar this week. Much will depend on the outcome of the FOMC. If we do break higher, there will be resistance here at this high here, so 93.5. And then again, as we approach the 38.2 FIBO level, which is at 94.5, and that remains a long way off. The momentum is not really there at the moment for us to see that kind of move. We'll have a quick look at the dailies. And as you can see, we've been consolidating around this level now for really quite some time. The daily indicators are completely flat, so I'm not really expecting an awful lot, at least until the FOMC meeting on Wednesday. We really need to hold above this neckline now to give us the momentum to push forward. But if we do hang around here, I can see the possibility that we might just peel off and head back lower. That remains to be seen. And we're going to have a look at the euro chart and see what that wants to tell us. So here we start with a 4-hour chart of the euro. And as you can see, there's very little momentum there either way. We've got this is the neckline, which we can see better on the daily charts. But we're hanging around. If we hang into this, I would imagine the market's probably short, looking for a break to the downside. Because if that does happen, there's the possibility of quite a decent trend lower for the euro. But if we hang in here, then the shorts might give up and push us back higher. But really, with momentum at neutral, we're not really getting any guidance either way to start the week. The dailies, as you can see here, we have the neckline, trying to break below it, but without any real success. If we do make further progress, this FIBO level, which ties in with this low here, just around 117, is going to be decent support. And then we've got these lows down around here at 116 and the 50% FIBO pivot at 115 basically. Don't really expect to see anything like that this week. The daily indicators slightly oversold, but there's room to the downside, but they're pretty much in neutral. And I think we have to understand that we're probably likely to be in a pretty tight range to start off the week. So as far as that goes, I'd probably be looking to buy dips if we saw it move down to this sort of level here, so 117.40, 50. I'd certainly be looking to sell rallies. This was the high where the ECB meeting announcement occurred, so that's 118.25. And for the time being, I think I'd probably just play that range and then be square ahead of the FOMC, but I'm not really expecting too many surprises out of that either. The rest of the FX market looks pretty range bound as well. Dollar yen had a bit of a spit after the sell-off in oil on Monday. We'll have a look at that. And so here we have a 4-hour chart of dollar yen. Got down to just above 109 after the sell-off, in line with the lower oil price. But as oil's recovered, so has dollar yen, and we're sitting back here at 110.50. And I don't think really we should expect too much outside of the 110, 111 range early in the week. The 4-hour charts, if anything, look slightly positive. So maybe we might go a little bit higher. The dailies had been pointing lower, but seem to have found some neutrality here. The RSIs are pretty much in the middle, so I wouldn't be looking for too much. And as I say, I would just play the range of 110, 111 early in the week. Sterling got sold off early in the week because in line with everything else when the oil price collapsed, but it's recovered ever since then. We've had this Freedom Day in the UK. The market's not really quite sure what to make of that. If COVID cases really take off, I think that'll probably cap the upside for sterling. But in the meantime, it looks as though we might have a minor bull flag here, a bit of a positive flagpole. If that eventuates, that could take us back up towards this 139 a figure level. But I'm not really looking for an awful lot. The 4 hourlies look slightly positive, perhaps. The dailies are not really telling us much at all. But we are hanging on above the 200-day moving average. So if anything, I'd probably be looking to buy it at around 137 with a stop loss below. That's a 136.50. But I don't think we're likely to get much above this 139 100-day moving average here, which kind of ties in with that flag that we were just talking about. The Aussie had an interesting week, got down to 72.90, an 8-month low, but has recovered since then in line with improved risk sentiment. Closed the week out at 73.60. The dailies had been pointing lower. Maybe they're trying to flatten out a little bit now, a bit more neutrality. The 4-hour charts actually look relatively positive to start the week, so maybe we do see a blip high, but I think in line with the lockdown in Sydney and Melbourne and Adelaide, I don't think we should be expecting the Aussie to make too many advances. So once again, I'd probably be looking for a range trade early in the week. I'd probably be looking to buy it at sort of down dips towards 73 with a stop loss under the low at 72.90. And on the top side, I can't really see it much going above 74 at the moment. We've got inflation data coming out on Wednesday, I think it is, from Australia, although that'll be Q2 inflation data and won't include any of the lockdown numbers. So that's expected to be about 0.7 for Q2. I think the trim mean number, I think, is 0.5% for the quarter. So depending on the outcome of that, we might see something directional from the Aussie. But overall, I think 73, 74 is likely to cover it. The Kiwi, likewise, that made a new multi-month low down here at 68.80 on early last week, but has recovered since then, closed at 69.75. Once again, I think we're probably likely to have some choppy range-bound trade near current levels. I'll be looking to sort of sell it above 70 cents. I think, and probably buying it on a dip, say towards sort of 69, 20, 30, somewhere around there, but with a stop loss placed under the 68.80 level where it fell to last Monday. The currencies they're not really showing much inspiration to me at all. The stock market's probably the way to go at the moment. We'll go and have a look at those. And here we have a daily chart of the S&P, which finished at an all-time high, as did the NzdUsd. We'll just have a quick look at that. That also finished at an all-time high, and as I previously said, we've got all the heavyweight tech companies reporting this week, so further advances wouldn't really be much of a surprise. Going back to the S&P, and here we have a 4-hour chart. Basically, I think for the time being, you look to buy the dips. This level here, 43.80 or so, probably with a stop loss below 43.40 for the time being. I don't think we're going to see it down there. The 4-hour indicators look positive. The dailies beginning to potentially point a little bit higher. I think any move higher is going to be a slow grind. And one day, as with Monday, we're probably going to see a bit of an accident. But you have to look to be able to buy those dips rather than get yourself cut out. So you do need to keep an eye on that. But this level down here, we did see it move down to 42.20, so it was quite a nasty surprise. But the smart money, I think, was looking to buy dips, and this is why we've got this sharp move back higher here. And I think it's going to just continue slowly as the summer progresses, unless we see any major downturn in economic numbers, looking basically to buy dips. Currently at around 4,400, I think we're probably looking for a slow but steady move to 44.25 and then 44.50, and probably by the end of the year towards 4,500. I won't do the other major US indices. There's basically going to be looking to do the same sort of thing. I will have a quick look at the ASX, and here we have a 4-hour chart of the ASX 200. Now, having spent a couple of months trading this choppy, nasty sideways range, we finally broken higher on Friday. Goodness knows why, with Sydney and Melbourne in lockdown, making all-time highs seems a bit rash to me, but you've got to go with it. It's following the US indices. And it has to be said, the 4-hour charts look positive for a decent start on Monday, and the dailies are pretty flat for the time being. So maybe the market's looking forward to when Sydney and Melbourne actually come out of lockdown. Victoria should come out of lockdown, I believe, later next week, but Sydney looks to be pretty stuck for the time being. But maybe the market's looking ahead as to the prospect of when the markets do turn higher. Let me just correct that, FIBO. And for the time being, I think you probably just go with it. With a stop loss now, I would put on this particular index, 74.16 we are at the moment, I'd have a stop loss below Friday's low at 73.60. Looking for a slow grind higher, and I'd probably have the trailing stop moving slowly higher, 50, 60 points behind the peak of the market. So that's that for the time being. So we'll have a quick look at a couple of commodities. Gold to start off with. Well, as long as risk sentiment remains positive, I guess gold will remain on the defensive, and it certainly looks to be that way at the moment. We're hanging on above decent support here in the sort of $1,790 to $1,800 an ounce region. If we were to go through that, then I think we'd probably make a fairly sharp move down here, sort of 1765.70, and below that 1750, and possibly even to sort of 1730. Pretty much dependent on risk sentiment, though. Anything that changes that can quickly see gold turn higher. For the time being, we're stuck below high of last week, 1833. And if we go and look at the daily charts, it could well be, let me just blow that up, it could well be that we just sit between this the 100 and the 200-day moving averages. That's around 1825 and 1790. So I'd use those as parameters. The daily charts are pretty neutral. I think there's probably better things to trade out there at the moment. But longer term, I'm bullish on gold. But I think you've got to look for your levels to buy it. And I'm not quite sure that really that right now we're currently at those levels. I much prefer to see it down towards between 1680 and sort of 1730 really. But that doesn't seem to be on the cards at this point in time. But we play that as a waiting game. Oil had this sharp sell-off down to 65 bucks a barrel after the OPEC meeting last week, but has recovered strongly since to sit at above 72. And with the 4-hour charts looking positive, I wouldn't be surprised to see further gains early in the week. Of course, everything is dependent on the outlook for the economy, but with the upcoming company reports this week looking pretty positive overall, I think oil should remain underpinned. The daily charts not really telling us an awful lot. So maybe we just play a range of something like 68 to 75, but overall the theme of buying dips is the one that I prefer to look at, I think. So that's about it. We'll have a quick look at the calendar. So here we are. There's not a lot on Monday. Kiwi trade balance. The German IFO might provide some interest in the euro, but apart from that, there's not an awful lot. So some secondary US data. Tuesday sees nothing really until the States come in, when we've got the durable goods orders and some more secondary data. The real action will be on Wednesday. As I said earlier, we've got the Australian inflation for second quarter, and then we've got the Fed meeting, which, as I previously said, I'm not really expecting any major surprise. But I'd be running a fairly square book through it, just in case they do come up with something left field. Thursday, as you can see, there's really precious little. Once again, until we get to Europe, we've got the German inflation numbers, and then we've got the preliminary reading of the Q2 US GDP, which is expected to be a pretty solid number. After that, really, the market kind of tails off into Friday. We've got the German GDP, the EU CPI, and also the QU GDP monthly. This is the monthly CPI, quarterly GDP, and then we've got some more secondary data coming out of the States, finishing up with the Michigan Consumer Sentiment Index on Friday. So that's about it. All in all, I think aside from the Fed, it's really going to be a week of looking at corporate earnings numbers, and that will provide the direction of the market. But I think they're going to be fairly solid, and that the positive risk sentiment should remain intact. So we'll leave it there for now, folks. Have a good one, and we'll talk to you next week. Cheers.